Hey guys, welcome back. And if you're new here, just welcome. Continuing with the 2022 Dividend ETF Overview series, we're back today with a State Street Global Advisor ETF. It's the SPDR S&P Dividend Aristocrat ETF. It's a little spin on what we normally think of dividend aristocrats, right? We normally think of them as 25-year consecutive dividends and all that. This is slightly tweaked, okay? And we'll go over that as we go along. Now, if you missed last week's videos, there were 4 of them. I'm going to leave the playlist down below. We're going through all the dividend ETFs by assets under management. We've done the 4 largest last week, and it'd be nice if you check those out. So today we're looking at ticker symbol SDY. I got to tell you, I'm impressed with State Street's website. I wish every website was like this. I don't have to go through a whole bunch of different things. It's all on one page and it's really nicely laid out. So we're just going to, like I said, we're just going to go through an overview. We're going to look at, portfolio composition, sector allocation, dividend growth and performance, all that good stuff. So let's get into it. So like I said, ticker symbol SDY, assets under management as of January 6th, 21 billion, 68.87 million. Currently trading for right around $130 per share. Gross expense ratio, respectable 0.35. So what the SPDR Dividend ETF seeks to provide investment results that, before fees and expenses, correspond generally to the total return performance of the S&P High Yield Dividend Aristocrats Index. So what does the index do? The index screens for companies that have consistently increased their dividend for at least 20 consecutive years and weights the stock by yield. So due to the index screen for 20 years of consecutively raising dividends, stocks included in the index have both capital growth and dividend income characteristics as opposed to stocks that are pure yield. So what's the difference? Typically when we think of dividend aristocrats, we think of 25 years, right? That's part of the S&P 500. But beyond that, there's also an S&P 1500. So that's where this ETF gets its universe from. So there's other stocks that are outside the S&P 500 that will give you 20 years of consistently raising dividends. They're just not in the S&P 500. So that's where the little twist comes, okay? And that's showing you right here. It's measures the performance of the highest dividend yielding S&P Composite 1500. Now the 1500 does include the 500, by the way. They are weighted by dividend yield. So the highest yielders in there are going to be top heavy. The index components are reviewed annually in January for continued inclusion in the index and reweighted quarterly after the closing of the last business day of January, April, July, and October. So we'll go down here and look at, they got some good information on this site. That's why I wish other sites kind of followed this. Look at this, fund characteristics. Estimated 3 to 5 year earnings per share growth, 12.3%. Has 114 holdings in the fund. The price to book ratio, 2.72. And the, let's see, what is this one? F1Y, what does that mean? Fiscal year? Price to earnings ratio of 17.5. So pretty much somewhat of a value fund, considering S&P is trading at about 24 at the moment. So the average market cap, $71 billion. Is that 71 billion? Yeah. So this one, what this shows is the fund characteristics and the index characteristics. So what they're showing you is how well they follow the index. And over here, you'll see they're a little off. It really just depends. Nope. Price to earnings ratio, 17.5 and 17.5. So, and the number of holdings, 114 and 114. So some ETFs don't exactly follow the index 100%, but they're following it pretty well here. So 30-day yield, got a distribution yield of about 2.5%. They say 2.8 for the index, and the fund's 2.6. So it might be a little bit of rotation. Also, the expense ratio as well takes away from the index, because the index has no expense fees. So we'll look down here and take a look at its, we'll look at performance on another screen, but we're going to look at its holdings. And top 10 holdings are going to be all familiar names, and they're all going to be kind of old classic companies. Some of them you probably never heard of, but AT&T is the #1 position. It'd be interesting what happens here when AT&T finally cuts the dividend, and see what replaces it, or if it's replaced at all. ExxonMobil #2, AbbVie #3, Chevron #4, Triple Net, which is the it's a REIT, #5. Classic IBM, pulling up #6. Consolidated Edison, a utility. People's United Financial is a regional, I believe it's a regional bank. Realty Income, so another REIT, that's ticker symbol O. And Walgreens Boots Alliance for the healthcare retail side. So let's take a look at the sector allocation here. And as of January 6th, consumer staples takes the top list at 16.43, followed very closely by financials at 15.3, followed closely again by industrials at 15%, 13% of utilities, 8.5% in materials, 6.7% in healthcare, 6.3% in consumer discretionary, 6% in real estate, 4.6% in energy, 4.4% in communication services, and information technology bringing up the rear at 3%. So we are missing, what are we missing here? 3, 4, 5, 6, 7, 8, 9, 10, 11. No, you got them all. And the drawback to this fund is going to be information technology only having 3%. And the reason why that is because there just isn't that very many companies in the tech sector just yet that fall within that screen of having 20 years of dividends. So it might take a while for that to happen. And in the meantime, that will probably put a little bit of a damper on the growth of this fund. And, over time, information technology will probably creep up in as far as weighting is concerned. So that's it for the SDY sector allocation and holdings. Let's take a look at the dividend growth. We're going to use Seeking Alpha for that. And you'll see Seeking Alpha shows 2.6% again as a yield. Dividend growth rate trailing 12 months, 12.2%, really good. 3-year CAGR, which is compounded annual growth rate, so average is 11.58%. 5-year 8.69%, and 10-year a respectable 7%. See, what happens is over long periods of time, some of these companies are like really old, like AT&T, right? They've only increased their dividend like 2% for every year for so many years. So that kind of drags down this ETF, since it is yield weighted heavy to the top. So consecutive years of dividend growth right now sitting at 4 years, and consecutive years of dividend payments 14 years. Now let's take a look at performance, and we're going to compare it against the big dog, which is SCHD. This is going to give us the at least 10 years of comparison here, and we're doing SCHD because it has been the best performer so far in the series, so we'll just compare it to SCHD. So we'll click on that, let that populate, and we'll see SDY gave you a respectable, since 2011, respectable annual return of 13.3% compared to SCHD's 15.3%. Like I said, I believe that's going to be a cause of mainly SDY's weighting in tech being so low. So, but otherwise, other than that, very solid ETF. Very solid annual returns, respectable dividend growth, and a good diversified basket of stocks. So let me know your thoughts down below. This is SDY. If you missed any of the other ones, check out the playlist down below. You guys have a good day. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.